And every time that momentum is this oversold, you are typically somewhere close to a bottom.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week for a weekly market recap with my good friend, the rebounding portfolio analyst, Lance Roberts. How are you, Lance?
Rebounding, how's that?
Well, I'm hoping that may apply to the market here, since the market's been falling over the past week, and
Yep.
curious if we're oversold and due for a bounce.
Yep.
Secondly, it should apply nicely to our rant if we have time to get there today.
Okay, perfect. Let's do it.
The basketball theme rant.
Okay.
All right. Well, look, why don't we just start with the punchline? Rough week for stocks. Last week, we were sort of raising the question, was the sell-off over? This week has shown, at least up until Friday morning, no. But I have been following you on Twitter, Lance. I'm going to guess you are going to tell us here that the market is probably quite oversold in the short term here, but don't let me put words in your mouth.
Yeah, no, that's pretty much the case. If you take a look, kind of, it's actually, let's just back up here real quick. It's actually very interesting what's going on. So I wrote an article last week talking about bearish sentiment. I think I shared some charts with you, but bearish sentiments among retail investors is at levels that are on par with the financial crisis, the 2020 pandemic, et cetera. So, investors are about as bearish as they can be on the overall market. The market's down about 7% from its peak. So we've had a very mild correction, and yet investors are treating this like, oh my gosh, this is, a huge market crash and everything is over now. And you don't have to go back very far. We had a 8.5% correction last August, which was the whole issue with the yen carry trade blow up, and everybody was like, oh my gosh, this changes everything. The yen carry trade's blown up and dollar de-dollarization and all that. And of course, then the market rallies back and hits all-time highs. Go back to April of last year, and you and I were talking here on the show in February, March, saying, hey, markets are super overbought here. You're going to get a correction. And we had about a 6% correction in April of last year. So, these corrections happen all the time. The average correction in any given year is 5%. 10% corrections are not uncommon at all, and are generally good buying opportunities to put money to work. And this is the fascinating thing about investor psychology, is that 2 weeks ago, markets were hitting all-time highs. And everybody was talking like, well, the AI, growth narrative is changing. DeepSeek changed the growth narrative and the outlook on earnings and all those type of things. Well, something that we've been writing about since the beginning of the year is that earnings expectations are too high. Markets are going to have to reprice for a new reality. Wrote an article called Curb Your Enthusiasm. Says, hey, expect a lot more volatility this year as markets reprice for a slower than expected earnings growth. So that's what's going on here. All we're doing is now we have repriced a lot of these stocks for a slower than expected earnings growth rate. Let's do some simple math here real quick. Now I'm doing this off the cuff, so don't nail me on the numbers if I'm off a little bit. But let's assume that the market's trading at 6,000, just for example. And markets are looking forward at the time. They're saying, okay, well, in the next 2 years, earnings are going to be $290 a share, which gives us a forward PE of 21 times earnings. So that's reasonable, right? We're going to bring the valuations of the markets down through expanded earnings growth, and so people buy that, right? And that's why markets are going up, and we're overpaying for assets because we're expecting this earnings growth to catch up. So we say, well, at 21 times earnings, I'm willing to pay X for whatever stock or whatever market is today. So flash forward, now all of a sudden we've got issues, right? Tariffs. How's that going to impact earnings? How's that going to impact economic growth? Those type of things. So now the markets are going, well, maybe we're not going to get $290 a share in earnings. Maybe we're only going to get $270 a share in earnings by next year. So pretty decent haircut to earnings. At 21 times earnings, that prices the market around 5,500. So we clip 500 points off the markets, and now we're at the same valuation expectation, but at a lower price because we're now expecting lower earnings. And that's all that's happening in the markets right now. And so when we start looking at what's happening, we start extrapolating these narratives to suggest that, oh my gosh, this is the next turnbuckle event in the markets, and we're going to have this next financial crisis or whatever it is. And that's not the case, right? That's not what's going on right now. We had a lot of leverage in the markets. We had a lot of exuberance. Investor exuberance was at all-time highs. And you reversed all of that. And we can go through technical charts here in a few minutes, but we have now driven markets to levels on a basis that you don't normally see in we've driven levels to an oversold basis that normally you see during much deeper corrections, and the bearish sentiment, et cetera, are at levels that are normally equated to much deeper levels of market corrections, and it's been 7%. So, it's quite fascinating. And we talked about valuations on stocks, and one of the favorite pick-ons has been the mega cap stocks. I'll share a quick chart with you real quick. I wrote an article about this earlier this week, but this is a chart of valuations on a heat map. So, people are familiar with heat maps, and so this is basically heat map earnings of companies and where they trade relative to the S&P. And of course, everybody's been kind of picking on NVIDIA. NVIDIA is so expensive because the price is high. But it trades at 19 times earnings on a forward basis, which is cheaper than the actual overall market right now. You take a look at Meta, it trades at 21 times earnings. That's cheaper than the markets. There's a lot of companies out there, JP Morgan, Morgan Stanley, et cetera, trading much cheaper than the overall market. So you've got to be really careful with these narratives that something is expensive just because of the price. You have to understand the fundamentals of it and how it's growing and what's happening with it underneath the surface. And so when you start looking at things this way, all of a sudden, the valuation argument takes a whole different turn in terms of investing, because as investors, what's our job? Our job is to buy things when nobody else wants to buy it. And right now, nobody wants to buy assets, right? A couple of weeks ago at all-time highs, people couldn't wait to buy stuff. Markets are going up. We're going to make all this money. Now, 7% correction. Everybody's like, I got to get out of the markets. Well, isn't this exactly the time that you're supposed to be buying assets, not selling them?
All right. So lots of questions raised by this. And yes, I do remember our conversation from last week where you were talking about NVIDIA. It's PEG ratio, it's price to earnings growth ratio, which is actually really attractive. It's really quite low.
Yeah.
So yes, you've got to can't just look at the headline data. You got to dig beneath to really see what's going on. Yep. So first question, Lance. First question, presumably because sentiment's so bearish, that's why you led with this big red bear behind you on the screen, I take it today.
Well, no, I just figured you were going to be super bearish today, so this is for you.
Oh, no, look, I'm talking all about bounces. So to your point, though, about, hey, all that's going on is sort of what we predicted, which is that the market is waking up to the fact that earnings growth was too aggressive for next year, and they're starting to ratchet that down. So prices need to come down. So that begs the question then, well, is it going to bounce, or should we not expect a bounce because the haircut that the market has taken is deserved?
Well, so how does Wall Street work, right? So let's go back to my example about 21 times earnings. So at $290 a share at 21 times forward earnings, everybody's willing to buy stocks because they expected earnings to grow, right? So now the market corrects to reprice for 21 times earnings on a new earnings level, right? And so once we do that haircut, then that's where Wall Street starts buying stocks. It's like, okay, I've reduced the expectation. Now I can start buying these stocks again because they're cheap on a forward basis relative to what I'm expecting from earnings growth. And so then if anything comes along that improves that outlook for earnings growth, then that's just that increases the buying ultimately at that point. And again, remember, this is all about psychology. Market corrections are all about psychology. We've talked about this before. Sellers live higher, buyers live lower. And so at some point, what's happening right now is that everybody that was buying, they were, kind of jumping into the markets wanting to buy assets at higher prices, and sellers were going, I don't really want to sell here because I think prices are going to go higher. So it was really hard to bring a seller to market. You had to keep bidding up the price of the stock to get somebody to go, okay, fine, I'll sell you my NVIDIA or my Apple or whatever, right? So you had to keep bidding the price up. Well, now what happens, and what's going on right now is that all the buyers that were trying to bid up prices earlier, they're now becoming sellers, and the ones that are willing to buy, like us, are going, yeah, we'll buy from you, but it's going to be down here. And so these prices have had to come down to levels that are much more attractive from an entry point. And we've been using the last couple of days to nibble on stocks as we've had these declines in positions, because you don't get these opportunities very often to buy stuff that's trading at a 2 or 3 standard deviation below their normal means.
Okay, so let me restate what I said earlier then, which
Sure.
is okay. So the market has taken its haircut.
Mhm.
A good chunk of that, I think you would say, deservedly so, right? Market waking up to the fact that we
Sure.
were overpricing earnings, and now we have a better sense of what we think earnings going to be. Prices are coming down. They've come down perhaps so much so that the buyers are now saying, okay, I'm willing to come in here. And so we may get a bounce, but unlikely, never say never, but
Mhm.
unlikely we're going to go right back up to all-time highs
Unlikely.
because this has been a repricing,
Yeah,
right?
yeah,
Not,
exactly.
yeah.
Well, well, first of all, we will eventually get to all-time highs. It may
That-
be a month from
Markets,
now, it
right,
might be a year from now, right?
right.
But we will get back to all-time highs, and we'll set new highs, and the markets will keep going up over time because economic growth, earnings growth, et cetera.
Yeah,
So,
yeah. I'm talking the
but
short term, which you
right,
know,
right.
yeah.
But over the next month, 2, 3, I mean, look, there is a very reasonable, and this is something we stated back in January of this year, is that there is not an inconsequential risk that we have already seen the highs for this year. Now, that doesn't mean that the markets are just going to correct indefinitely. We've been talking about since the beginning of this year, expect more volatility, expect some 5 or 10% decline this year. Then you're going to get a rally back. Then you're going to have another 5 or 10% decline. Then you're going to rally back. And at the end of the year, we're about where we started, give or take, more or less.
Yeah.
That's kind of the setup that's going through as markets are digesting what's going on with tariffs. And unfortunately, it's interesting. You and I have had this discussion about, if I was president, what I would do is coming in the office saying, hey, I'm going to do all these things. Please expect some market pain. Please expect some disruption. While I do this, it's going to be better in the long run. But while I do this, expect some pain. And I thought it's been interesting that Trump has made some of those comments of, hey, I'm doing this. It's going to benefit the economy long run. I'm not even looking at the stock market right now, which is
Yeah.
very different than his first term. At this stage of his
Yeah,
first
he hasn't
term,
said that exactly there, right? Because I've been listening for exactly that. I haven't
yeah.
heard exactly that yet.
Well, no, that was a headline on CNBC yesterday. So whether he said that specifically or whether that was interpreted, but that was CNBC's headline.
Okay.
But the point is that, but more to that issue though, during his first term up to this point, he had tweeted about the stock market 126 times. He's tweeted about the market like twice at
Yeah.
this point. So, the point is that, he's pulled away from the market as a measure of what he's doing. He's focusing on his task at hand. The markets are stuck with all of this policy uncertainty because, yesterday we've got tariffs. Now tariffs are delayed until April, and then we have tariffs, and then they get delayed. And again, as we talked about before, all these tariffs are just stick and carrot, right? I'm going to hit you with a tariff. You now negotiate. We take the tariffs off, rebalance them, whatever. He's got an agenda of what he wants to do in terms of these tariffs and negotiating better trade deals. That's great, fantastic, wonderful. But that this kind of on and off thing back and forth is tough on the markets because they can't price for what the impact of tariffs are going to be, because one day you've got a 25% tariff, the next day you don't. How do I adjust that into earnings? So this is leading to all this uncertainty in the markets, and the kind of markets are just sitting back now, just going, what? I'm just going to step aside for the moment until this gets sorted out.
So this was my next question. So how much of the repricing we've seen, or how much of the dip in the market we've seen, is due to repricing of earnings expectations versus investors just saying too much uncertainty? I don't know. I got to put a discount in for that.
At the end of the day, it's always about earnings, right?
Okay.
So there is an extremely high correlation between earnings growth in the markets on a year-over-year basis. So at the end of the day, the short-term narratives of whatever the headline is, and whoever's kind of preaching a headline, the market's going to die and whatever's going to happen, or the market's going to race up to the moon and this is going to happen. That's all fine. That's all short-term volatility, and that impacts investor sentiment, right? And that's where we see these sentiment moves all over the place. But at the end of the day, if you want to know where the market's going, just take a look at earnings. And the growth rate of earnings on an annualized basis will tell you the direction of the markets over the next 6 to 9 months.
Okay. Okay. I just want to revisit very quickly a point
Sure.
we mentioned last week, just to see if you still believe it's the case. So is part of this hypersensitivity of sentiment, right? Where it's either like the most euphoric we've ever been, which is kind of like 2 weeks ago,
Yeah.
to, oh my God, this is almost as bad as a recession, right? 2 weeks later. Um, we talked last week that could be due to the you know greater amount of leverage in these highly speculative
Mhm.
asset classes that are out there, like the single stock ETFs and things like that,
Yep.
where when you are placing these leveraged bets, you are either doing really well, market goes up a little bit, you go up a lot, so you're really happy, right? Or market goes down a little bit, but you're getting crushed, and so
Mhm.
you're really hurting. So, does that increase the extremity of the reading of the overall sentiment, right? Because you have this let's assume it's 15% of the market is now in these more speculative trades. Yeah, they're at a tail end, but they're getting such an extreme response that they are pulling the average up or down based upon which direction markets are moving in.
Well, no, definitely. I mean, look, over the last decade, we have just, and really this has been going on for really 25 years, ever since the turn of the century. But when we moved to decimalization and internet trading and 24/7 financial media news and being able to log on to every type of account you have and watch it move in real time, et cetera, we just changed this whole market to pretty much a casino. And so investors are now hypersensitive to market moves, and it's dragging sentiment all over the place. And again, the more leverage you have in the markets, the faster these moves become in your personal. So for instance, like none of this over the last 3 weeks since this started has changed my attitude about the markets at all. Our portfolios are down about 1.5%. The market's down 7. So because we don't carry leverage and because we keep a well diversified and balanced portfolio, these swings in the markets don't affect our portfolio much. So and so in that environment, I'm not being pulled like, oh my gosh, I've got to do something. I can take my time. And we sold a couple of things this week and we've added a couple of things this week, and just kind of working around the edges, because I'm not being forced to do something because I had, a bunch of my portfolio was 3x leveraged Qs and, option
MicroStrategy.
trades that were blowing up to zero. And I had a bunch of micro strategy that's dropped 80%, whatever. That when you have that type of portfolio and you're getting absolutely decimated in this market, and look, there's a lot of retail investors. The market's down 7. They're down 15, 20, 25, or 30% right now because of the assets that they were holding, because of
Mhm.
that leverage. And if they were on margin call, they're getting wiped out at this point because of those drops. So, and so, yeah, when you call those people and say, how do you feel about the market? Oh, it sucks. It's terrible. That's just a fun. But that's feeding in because we've got so many people now on the retail side that are playing that game and taking on very speculative, risky bets, buying stocks that really they don't understand what they're buying in terms of beta. They overweight them in your portfolio. We had a long discussion this week on our YouTube channel about turtle trading. And Michael Coley wrote this book about turtle trading, and it goes a lot into risk position sizing, the mathematics behind it, understanding the consequences of beta relative to your portfolio. And and that's a huge driver of investor psychology, is when you overweight positions that have a high beta and they go against you, it causes emotional distress, and that's what shows up in all these sentiment indicators.
Yeah, it's funny. This is like the second or third video this week I'm making this statement on, but I think I'm going to do a video relatively soon, or maybe I'll do it as a rant here at some point about prospect theory.
Mm-hmm.
Um, if you guys have heard Daniel Kahneman, the famous behavioral economist, he wrote the book Thinking Fast and Slow, but I believe he won a Nobel Prize for this theory. And there's a lot we can take from it, but the important thing I take from it is that psychologically, we as humans, the way our brains are wired, we experience the pain of a loss about twice as much as we enjoy the joy of a gain.
Right.
And so, when we're making money in the stock market, it feels great, right? That greed factor takes over. But we really have to remind ourselves that it's much better to mitigate losses in terms of how we're going to feel emotionally than it is to stretch for gain. Because if we're wrong, it feels way worse for us. If your goal is to enjoy life and be able to sleep at night, you really want to have a loss minimization strategy before you start stretching for gains. All right, so a couple quick things on this, and then we'll move on. Well, and actually, before we do move on from this, Lance, we probably should pull up the S&P and just look at what the charts say. But before you pull that up, you mentioned that Trump isn't beating his chest about the markets nearly as much as he did during his first term,
Right.
um, and barely at all. So the absence is it's a very loud silence on this topic. And he did in his address to Congress earlier this week. There's a few things I want to talk with you about that.
Sure.
But he did at one point. It was kind of around tariffs impact on farmers. But I sort of took it as him opening the door on this communication that you and I have been saying he should do, where he said, "Hey, look, there's going to be a little. I can't remember the exact word he used, but like a little disruption or something. It wasn't disruption, but there was, basically saying, look, it's getting a little rocky for a little while, but bear with me, right?" And I think that's the right kind of communication that I would advise him to do, which is like, yeah, it's going to get rocky, folks, and maybe even the R word. And Trump really can't say recession because if he did, everybody would panic and it would happen overnight. But I think he's beginning to do that. But I've definitely seen comments from guys like Treasury Secretary Scott Bessent, who does seem to be maybe handed the mantle of telling folks, hey, slow your roll on short-term expectations in the economy here. It's going to take a while for this stuff to really start to bear fruit. Even just, I think this morning, he was asked about, are these tariffs, especially against China, going to raise prices at all? And isn't that bad for Americans? And he basically said, like buying cheap crap from China isn't
It's not the American dream.
yeah, it's basically not an American birthright. Like that's not the American dream. The American dream is being able to work hard, advance your station, afford a middle class lifestyle here. And he said that's what we're trying to work for here. And without saying it in so many words, he's like, look, we're going to have to give up maybe some conveniences in the short term. We're going to have to tighten our belt a little bit as we rejigger the American economy. But we're doing all this, in their words, to try to help revive Main Street and be a little bit less concerned about Wall Street. So people may believe that or doubt that, whatever, they might think it's good or bad. But it does seem to be the message the administration is starting to be a little more clear on is, hey, folks, we're going to take some lumps before the things we're working to begin to bear fruit, which you and I have always said was the right thing to do.
Yeah, exactly. And we were talking about that, before he even took office this year, saying, this is the first thing I would do is just tell people, it's like, hey, it's going to be a little bit bumpy here for a while, and you're just going to have to work our way through it. But again, back to investing, this is what you want to look. And it's always interesting is that, the age old axiom is to sell high and buy low. But the one thing that investors just repeatedly do is they buy high and sell low. And every time markets go through corrections, like I was like, oh my gosh, I gotta get out of the market. This is where your fortitude has to step up and say, okay, what's my objectives? What am I trying to do with my portfolio? What am I trying to grow with it? And where are those opportunities? And look at the companies you own, and has the outlook for the companies dramatically changed? Or is this just a overreaction to a price decline? And now you've got deeply oversold assets to where, my goal is to buy something at a discount. And these, when things have big run-ups, they have big corrections, especially in high beta stocks. But this is the time that it's tough, right? This is the hard part about investing, is being able to buy a dip. And look, I may buy something today and it goes down further. You know what? I'll buy some more. As long as my thesis hasn't changed on the fundamentals, I'll buy that dip all the way down, because that's what I want to do, is build something in at a much lower cost, so I have a better opportunity to make money when it rises. But that's also why on the opposition of that, when markets are going crazy and going up, we're over here going, hey, we're taking profits here. We've rebalanced AbbVie twice this year. It's a 5% position in our portfolio. It went to 5.5%. We sold it back to 5%, and like 3 weeks later, it went back to 5.5%. So we sold it again. So we just, as things are escalating, we're taking profits, rebalancing back to target. And when things get underweight targets, that's the time to step in and bring it back to your target weights. But this goes all the way back to what I was saying earlier about turtle trading, is understanding your position sizing, understanding your risk bets, and managing that beta accordingly in your portfolio.
Yeah, and Lance, I mean, this is exactly why we have you on the channel every week, being transparent about how you apply the discipline and the time-honored practices of wealth building. So we want to make sure folks really see how it's done, and it's you can't trade emotionally, right? You've got to just trade rationally. You have to have a framework. You have to have a process. But it's one that time shows, you fare a lot better with that versus trading without. And one thing I want to add to that is, a little bit of a personal story, but we talk a lot on this channel as well about the wisdom of including hedges in your portfolio. And Lance, you may remember coming into the end of the year, there was a period there where S&P puts were about the cheapest that I think you and some of our other financial advisors had seen in their career. And so I went and bought some puts then. Yep. And a couple weeks later, and probably like a week later, I was up pretty substantially on them and feeling great about it. But I bought May puts, I think. So I mean, they were fairly long dated. So I said, well, all right, they're already making some money. Let's let this thing ride a little bit. Well, then the markets, went back up to all-time highs, totally underwater for a couple of months. And then this week, all of a sudden, they were back in the green. And then they weren't. And then they were. And then they weren't. And they kept flip-flopping day to day this week. I woke up yesterday and they were green again. And I said, you know what? Like, they've achieved their purpose. Yeah, I still have a little bit of time value in this left, but it's done exactly what I needed it to do, right? I had part of my portfolio that was down because the markets were down, and I had a nice hedge cushion here with these. I'm following your work, Lance, knowing that you were saying, look, markets are getting pretty oversold here. I said, look, don't look a gift horse in the mouth. Just take the return when your bet paid off the way that you expected it to. Don't get greedy. And it worked great. And again, that's just following the discipline of the practice of why you hedge, right? So very much have learned that from you and from New Harbor and some of the other financial advisors that have appeared on here. So again, having the framework and following it, even though, I'm sure when you with your experience, right, when you're pressing the sell button on an AbbVie because it's running off to the races, right, and you're doing your position rebalancing, there's got to be a little part of you that's like, no, this thing's running, like just keep
all the time. oh, trust me, I go back and look at our positions in Nvidia where we bought them, or where we bought Costco originally, or where we bought AbbVie originally, and I go, if I would have just left them alone, my portfolio would be so much larger today because of that. But, that's not good management, because what happens is that, AbbVie is a good example. Costco is a great example. That stock has just had a massive run for a stock that's really kind of more of a staple. Stock's down about 6-7% today on the earnings. Had still had great earnings, but, a little bit of a disappointment there. But, the process of rebalancing is, you give up some of your gains, and there's a lot of people like, oh, I never touch it, I just let it go, and of course their whole portfolio. Just a good example, we've got a client that we just started working with recently, and they have a massive position in Nvidia. They were buying Nvidia back, well, they work for the company, so they've been buying Nvidia since pretty much the beginning. Just a massive position in Nvidia. It's worth millions of dollars, and the problem now is how do you get out of it, right? How do you start diversifying into other assets and doing all this? Well, it's like, oh, this thing's just doing great, I don't want to sell it, but now that the stock's down 20% from the peak, all of a sudden they're very amenable to talking about diversification of their assets into other things, right? And this is the point about risk. Risk management is that you're going to give up some gains by managing risk. You're going to underperform the index one year or the next because you're managing risk. your goal is not to beat some random benchmark index. It's to grow your money safely over time and to make sure that your money today is there for you tomorrow, and it's adjusted for purchasing power parity in the future. That's inflation. So these are the things that we have to always focus on, and it's difficult and it's challenging. And look, I don't like days, I don't like weeks like we've had over the last couple of weeks when markets are down. Hey, it's not fun, right? But it's just part of the process. And the big part of investing is being able to understand this is just part of the process. And we can, and here, let's just do this. Let's just go to the chart of this, because this is a great lead in to understanding kind of where we are.
Great.
And talking about part of the process. Yeah, here we go. So this is a chart of the S&P going back to basically 2022. There's October, November 2022 at the bottom. This has been the bull market that we've had since then. You know, it's been a great bull market. We're currently doing there's a mathematical formula called Fibonacci. And Fibonacci the Fibonacci mathematics show up everywhere in the world, right? It's the length of the distance between your elbow and your fingertips. It's what makes a conch shell perfect. It specifies the number of sunflower seeds in a sunflower. All these things. I mean, the golden ratio shows up everywhere, and mathematically, it works very well with the markets as well. So what these shaded bars show you on the right is the Fibonacci sequence of a retracement. You can also do this for an advance as well. It works in both directions. But you take the low and you map out the high, and it tells you what you would expect in terms of your pullback. And the first level of a pullback is about a 25% retracement from the peak in terms of the run up from the low. So that doesn't mean you're down 25% from the peak. That's not what that's saying. Then it goes to 38.2, then a 50% retracement of the previous rally, 61.8% retracement, 78.6, and then 100% retracement. Normally, the vast majority of corrections reside in that 25 to 38.2 to 50% correction status. So you go back in history and look at any correction, for the most part, it stays somewhere within that realm, outside of like a financial crisis or a pandemic, which was, you know, kind of man-made at that point. So we're right now in that first 25% correction, and you're pulling down to a lot of previous supports. You got the 200-day moving average right here. You've got previous tops going back to July of last year before the yen carry trade blow up. You've got some previous bottoms in here that we had back in October and November. So again, you're in a really good position here. And I want you to note the momentum indicator at the top. So the top band is what's called a MACD. That's a moving average convergence and divergence indicator. And what it measures is whether the distance between the short-term moving average and the long-term moving average. So functionally, it's just a measure of market momentum. If we go back and look at where we are currently, just on a relative basis, and see how deeply sold we are right here. This momentum indicator is extremely low levels. We're down at negative 75-ish right now. We have to go back to the yen carry trade blow up to see another relative point like that. Go back to the October low. So this is that 10.5% correction we had summer before last in 2023. This is that 10.5% correction through the summer of 2023. That got us down to extremely oversold levels where we are now. And previous to that is the bottom in October of 2022. And this goes all the way back through history. I mean, I can scroll back years, and every time that momentum is this oversold, you are typically somewhere close to a bottom. Even if it's in a bear market, you're somewhere close to a bottom. And relative strength is on the bottom. This is this red line. And you're typically at levels that have previously always aligned with the market low. So just from an exhaustion standpoint, right? What moves prices up and down? It's the number of sellers versus the number of buyers. When everybody is selling, eventually everybody that wants to sell has sold. And so that only leaves the buyers available to step in and start buying assets. At some point, when markets are rallying very greatly, buyers exhaust themselves. They've bought all they want to buy, and then you have a correction. That's just what happened back here in mid-February. Buyers just exhausted themselves. We saw it coming. We talked about the deterioration of market breadth. We talked about the kind of negative divergence in RSI and momentum at that time, which was suggesting that buyers were becoming exhausted. And so they are having this correction. So this was not unanticipated. It was not unexpected, and certainly well within the confines of normality in terms of correctional processes. Now, that's kind of where we are. So what's the bad news about this? Well, the bad news is what happens next. So, and I should say it's not bad news, but it's not, as you said earlier, Adam, we're not about to have a race off to new highs. We've got a big congestion of moving average sitting right here around 6,000 on the index. You got the 20-day, the 50-day, the 100-day, all converging very closely together. So we're likely going to have a nice reflexive rally. This is going to get everybody bullish. We're going to see bullish sentiment start to shoot back higher. We'll see professional investors start to pile back into the market. And so we'll get this push higher to the market. So we're going to run into all that resistance right around 6,000. So from a portfolio management standpoint, if you didn't do anything up to this point, don't do anything now. Today is not the day to go sell your portfolio. Wait for that rally. You get back close to 59 to 6,000. And again, be very careful with numbers. Numbers are neighborhoods, right? It's not specific addresses. So when you're in the markets, when you get in the neighborhood of the price target. So if I said, look, the price target for this rally is 6,000. If you get to 59 and a quarter, 59 to 50, you're in the neighborhood. Use that to start rebalancing your portfolio. So again, if you didn't do anything up to this point, you've been beaten up, you got too much risk in your portfolio, start reducing the risk, start rebalancing your portfolio, becoming more conservative, whatever it is that you need to do in your portfolio, do that at that level. Don't wait specifically for six. Like I said, 6,000, I'm going to wait for that number. No, it's not an address. It's a neighborhood. So when you get in the neighborhood, start rebalancing your portfolio. If you're a trader and if you're opportunistic, now it's the time to start potentially buying a little bit. And if the market rallies up, then you can sell that. Well, like for instance, like we've been doing, and we'll sell and rebalance the portfolio back to target back at that level. So we're just looking for a tradable rally to add a little bit of growth to our portfolio, and then we'll reduce that exposure once again. But again, we're not going to go taking off to new highs anytime soon. And we can talk specifically about Trump's previous trade wars and those type of things and et cetera. But paying attention to where we are is very important. Now let's do one more bit of exercise here. So this was in today's daily market commentary that we publish both on Substack as well as on our website. So every day we produce a little short commentary. It's about a 3-minute read, and we talk about the markets, trading, those type of things, what's going on. By the way, I'm about 20 subscribers on Substack from 2000. So if y'all can help me out, go subscribe at Substack at Lance Roberts.
Congratulations, folks. Go subscribe.
Yeah. So this is today's article. What I did was, and so just kind of laying this out, I said yesterday we touched on intra-year market declines. So during a given year, like I said, every year markets are going to decline 5 to 10%, completely normal, right? Feels like crap, but it's completely normal decline. Happens every single year in the markets. And so we touched on that. I said during bull markets, relative strength tends to oscillate. This is very important. Tends to oscillate between 50 and 100, while the momentum, as measured by MACD indicator, tends to stay above 50. The opposite is true of bear markets. During bull markets, buying opportunities tend to exist when corrections push indicators back towards the lower levels of their weekly readings and vice versa. So I went back and I looked at 1999. So this is the market crash in 1999. There's one particular thing that you need to denote about what happened in 1999. So heading up into 1999, so February, March, April of 1999, 2000, we had the crash of Enron. We had, basically all this stuff starting to go wrong with the dot-com market. It wasn't until October that you actually got a signal to reduce risk. And that was where the MACD fell below zero, started trading negatively, and the moving averages, the weekly moving averages crossed over. So you had a very clear market sell signal in October to get out of the markets. And you were still near, despite all this volatility that was going on, right? You were still near all-time highs. But that signal got you out of the market. And then If you
Right.
didn't do,
Sorry, Matt.
right?
Just to be clear, though, you're talking about October of 2000 is when that happened, right?
Yeah, sorry, I said 1999. Apologies. October of 2000. Yes. So it wasn't until October of 2000 that you had the signal. But even if you didn't get out of the market then, right, and you rode this puppy down, at this point, you should be realizing that something's going wrong. Markets get deeply oversold here. So now we're back to those same indicators, right? So RSI trading near 30, your MACDs trading very negative, like just like they are today. You got a decent rally out of that. Now, it didn't go to all-time highs. It was a reflexive rally. You sell into that. You didn't get back to where you should have sold, but you're at a much better level to sell and start reducing your portfolio risk. But you didn't do it there either, right? Because you think this is just a temporary correction. Well, the market gives you another opportunity in October of 2001, and you get a nice rally back. Still not where you were previously, but hey, gives you a better entry point. You still didn't do it. So finally, in July of 2002, you're down about 50%, and the market marks a bottom. And then the market starts to rally and recover, and then just keeps going. And then eventually, these indicators start getting back into positive territory. This transition from below zero to above zero, below 50 to above 50, tells you that you're now back in a bull market. So this is why we wrote articles back in March and April of 2003 saying this is, we're back in a bull market, bear market's over, time to start buying. So again, same thing though, we look at 2008, financial crisis of 2008. MACD indicator above 50, your markets are okay, subprime is contained, everything is fine. Late 2007, really kind of December-ish of 2007, you got your MACD crossover. That was your indicator to start selling out. In fact, we wrote an article then that says the recession has just started in December of 2007. Now, we didn't know for certain until December of 2008 when the National Bureau of Economic Research dated it. But that was the point to start reducing risk. Market sold off, got very oversold, reflex rallied back to these previous bottoms. That was where we exited the market back then, because this part we weren't sure about was this was a correction or actually the start of a bear market. But by the time we got this reflexive rally at this failed trend line, that and also had a big head and shoulders violation here as well. That was the indicator to start really getting out of the market. And of course, the market fell apart in September of that year because of Lehman, et cetera. But people say, well, there was no warning. You had plenty of warning in the markets, and the technical indicators gave you that opportunity. And then really in November of 2008, the market started recovering. You had great buying opportunities in November 2008, March of 2009. We wrote an article in February of 2008 saying 8 reasons for a bull market. And that was a big chunk of what was going on with these indicators. You started getting negative divergences. You had rising MACDs, rising relative strength in a declining market. That's a beautiful setup for a market bottom. And that was the start of the bull market in 2008.
Sorry, you mean 2009, right?
2009, sorry. Too many dates. Here's 2022. This is the correction we had in 2022. This is where we got out of the market in 2022. We had the crossover there, reduced our exposure by about 50% during this whole decline. Market gave you multiple rallies to sell into this. And of course, this was where the Fed was flip-flopping back and forth, and expectations were, Fed's going to cut a lot, Fed's not going to cut, whatever it was. So you had these big counter trend rallies, and those gave you plenty of opportunities to exit the markets and rebalance risk. And then in late September, October, you and I started talking about extreme negative sentiment. We started getting positive divergences between the markets and indicators. And that told us that we were pretty much at the bottom of that bear market. And we were about to move back into the next kind of the bullish cycle. And of course, that's what's been going on since 2022. So the point about all this is that we're seeing very similar setups today. We're still in a bullish market right now. We're still trading above zero on MACDs. We're still trading above 50 on the RSIs. We're deeply oversold here. We're not anywhere close to a moving average crossover. Now that can occur, and it can occur fairly quickly. If this market rallies back towards 6,000, which is likely, and then rolls over and fails, that's going to start compressing these moving averages. And if that begins to occur, that's going to be your real signal that we're moving into a topping process. In fact, Tuesday's article that I'm writing about right now is about breadth and market tops. And we are exhibiting some relative similarities to this previous market top that we saw back in 2021. It takes a good bit of time to go through a topping process. We've not likely completed that topping process right now. So again, just as a function of portfolio management, this isn't the point to sell. The point to sell will be on the next rally that starts to complete that topping process, if that's where we are. Now, if we rally up to all-time highs in the next 3 months, then that topping process is negated.
Okay. Well, so this is kind of a seminal discussion then, Lance, because what I hear you saying here is, hey, I'm starting to see the precursors of a bear market.
Yeah.
Right. So I don't think you're saying, hey, folks, a bear market is definitely going to happen. As you mentioned, we'll see what happens from here, and that will help guide you. But let's take care to revisit those indicators, as we go on from here over the next couple of months, to see if they provide additional confirmation, or if they end up, being a false positive here.
Yeah. And look, I mean, there's things going on in the markets today that are certainly, because this Friday, markets are down about 1% as we're talking right now. We're violating the 200-day moving average, certainly worrisome, but we did that back in kind of October of 2023 as well. When we had that 10.5% correction of the summer, we violated the 200-day moving average. And that brought a lot of people out to the market saying, oh my gosh, we broke the 200-day, got to get out of the market. And then the market, that was the bottom. And then the markets took off from there. So again, there are certainly some indicators here that are certainly suggesting weakness, and we've got to pay attention to those. Again, there's some opportunities here for a tradable rally, but that doesn't necessarily mean that a tradable rally is the same as a bull market. So you've got some opportunities here to take advantage of a short-term oversold condition, and you rarely have a stretch of the market where it's just down every single day for multiple weeks in a row. You're going to exhaust sellers here. You're going to get a reflexive rally, and then from there you can make your next set of decisions. But there's certainly some, and again, this goes back to what we're talking about ever since the beginning of this year. Expect more volatility, expect corrections. Be more cautious with your risk management. This isn't going to be 2023, 2024, where you're just cranking out 20% returns every year. We're going to be lucky to crank out, a positive return this year, of 3 or 4 or 5% probably.
Okay. All right. Well, folks, look, we will be tracking this weekly with Lance. So we'll be keeping our fingers closely on the pulse of this. All right. So let's move over from the markets for a second to the economy. So in last week's video, Lance, I pulled up in real time the new GDP now numbers, which I think sort of shocked both of us. And then, of course, there was a lot of coverage of that in the media. It's now even a worse reading than it was back then. And let me see if I can pull it up here while we're talking. But I think last week when I pulled it up, it was negative. It had dropped from like 2.8 to negative 1.5%. It is now at negative 2.4%. So obviously, those are definitely recessionary readings. That being said, there's a lot going on with people trying to front run the tariffs, and I don't fully understand why, but actually, there's a lot of impact that gold shipments are having on that number too.
You don't understand why that's having impact on.
I don't understand why it's having such an oversized impact.
Because when you have to look at how GDP is calculated. So 70% of GDP, 68% is consumption. So that's personal consumption expenditures. Then you have business investment, then you have net exports. So net exports is imports minus exports. So when you have you've had record levels of imports that are coming in because people are reshoring their stores. So if I have gold stored in London and I'm in the US, I have to move that gold from London into the US, and that's an import. And so as I import that gold, or if I import it from Switzerland into the US, which is what's happening, that's an import. And so I'm trying to do that ahead of getting tariffs, because if I wait till after tariffs are imposed, if I import my gold in, I'm going to have to pay a 25% tariff on top of the gold. Right. So we've got record levels of imports, and that's skewing the whole net export thing. And this is a very temporary issue. So again, I wouldn't read a whole lot into GDP now. The
That,
next
that was going to be
updates,
my whole point here, right?
yeah,
It's just lots of dust in the air. Take it with a big grain of
yeah.
salt. Yeah.
And look, the employment report today wasn't fantastic, wasn't terrible. That's going to be a positive contribution to the next update in GDP. And also remember, the GDP now number is only using data from January. We don't have any real February data. Today's employment report was really the first data point we have for February. Everything else is for January. So we're just now starting. And so we still got February data and March data to go through. So, it's very likely you're going to see a big recovery in this GDP number by the time we get into March before we actually get the first quarter GDP report.
Yeah. Although my guess is, Lance, you would guess right now that it's going to be lower than average quarterly GDP from last year, right? I mean, we
Oh,
have
yeah,
been seeing a
absolutely.
slowing
Look,
trend. Yeah.
yeah, our whole expectation is this year is going to grow at 1.8 to 2%.
Okay. All right.
So,
Yeah. And so I totally get, and thanks for explaining that about the rush to import is what's pulling GDP down. I
yeah,
did get that point. The point I was just having trouble wrapping my brain around is, having been a gold investor for a long while, we don't expect anything in the economy to take notice of gold. So the fact that they're citing it as a contributor is like, wow, okay, wow.
yeah,
All right, but anyways, it's the number we have right now. So to a certain extent, it weighs on sentiment,
sure,
right?
absolutely.
Um, so I have a note here to let you talk about the article that you just showed us, so we don't even necessarily need to go there. But the article you were walking us through, I believe, that's the one you released today, is titled "The Risk of a Recession Isn't Zero."
No, it's
I
a
think
different one.
a different one. Okay, yeah, I think I mentioned on this with you last week, Lance, but I've mentioned it a lot recently. Is that we had a lot of debate a year ago about whether still, we might go into recession, hard landing, soft landing, et cetera. And then the no landing narrative won out middle of last year. And then nobody's worried about a recession until all of a sudden it's
Yep,
now back in the headlines, right?
yep,
So it's definitely weighing on sentiment. To your point, investors are starting to having to wake up now that the recession risk isn't zero. And that's probably part of what is getting priced in the markets now. I want to mention one thing, and then I'll let you say
sure.
whatever you want to say to this, Lance. Luke Roman, who I am interviewing for the upcoming Thoughtful Money conference in a week, he just put out this analysis that he did. Here's the chart of it. Let me just read this from his analysis real quickly. He wanted to look at how much government spending had been contributing to GDP. So he ran the GDP numbers for just the private part of the economy only, the private sector contribution to GDP, backing out government spending. And here's what he says. What we found startled us. Ex-government spending since 2000, the US private sector economy has essentially been in a long, silent depression, interrupted only by the housing bubble, the everything bubble, and everything bubble 2.0. Allow us to state this as bluntly as we can. Government spending and rising stock prices effectively are the US economy, and now the Trump administration is reducing both. So this is basically, Luke saying, look, government spending's basically been, carrying the vast amount of water for economic growth. And if indeed the Trump administration effectively delivers on the policies that they've now publicly put on the table, that tide that's been rising GDP or supporting GDP is going to start going out.
Yep. No, that's right, and that's really there's actually three factors, and this is really today's article that we wrote about. To kind of to your point, if you look back, I first wrote this article a while back, and but the other direction, this was back really in 2023ish, I think. But I wrote an article talking about the fact that analysts. I'm sorry, this was in 2022. So back in 2022, I wrote an article saying we're probably not going to have a recession because everybody is expecting a recession. And this was back in 2022 when everybody was expecting a recession to occur in 2023. And generally, when all experts agree,
Bob Farrell's rules.
Yep. When all experts agree, something else tends to happen. Of course, that's what happened. And so if we start looking at kind of this is GDP on an annual basis, and one of the things there's three factors really that we're looking at very closely right now because while there's no recession on the horizon in terms of the economic data, the risk of a recession isn't zero because of three things. And so if you look back at 2020 itself, in quarter one, quarter two, we had a recession, right? So that's marked as a recession. The National Bureau of Economic Research says that was a recession because we had a massive drop in employment, et cetera. Then we had two very, very weak quarters. Now, this is revised data. So on the revised economic data, the economy grew at 0.28% in the second quarter. But before that revision, we had two negative quarters, and you remember this, we had two negative quarters in a row in 2022 of GDP growth. And everybody's like, oh, the recession's here because we've had two negative quarters, and the National Bureau of Economic Research never announced it because employment was solid during that whole thing. We didn't have a big employment drop off. We were running about 4% unemployment rate. So the NBR said because of employment, we didn't have a recession. And that's a fair statement, for them to say that, because the employment was fairly strong. But this is the key kind of issue, is that what is happening in the Trump administration right now in particular, and that is the function of what's happening with employment. So you've got the government going after government jobs right now because of DOGE and other situations, Department of Education, Department of Energy, whatever they're going to do. So if you look back in 2022, 2023, into early 2024, job growth was strong. This is the employment net monthly change. So job growth is strong. NBR was right, not proclaiming a recession. But now let's look at something here. This is where it gets interesting. So when we start talking about employment, in particular, that we've got to talk about a couple of things. We've got to talk about immigration. We've got to talk about spending and where all this occurs. So if we take a look, and I'm scrolling for this chart. So here's the chart that I'm looking for. This is unauthorized immigrants and authorized immigrants and their position within the economy. And not unsurprising, this is not surprising at all, is that you find the majority of unauthorized immigrants working in landscaping, private households. Those are maids, cleaners, construction workers, et cetera, repairman, et cetera. Service producers to buildings, crop production, slaughtering and processing of animals, bakeries, restaurants, dry cleaning. This is where you expect to find them. And these are also happen to be the areas that have been the largest contributors to job growth. So when you get these employment numbers that come out, where are the most jobs created? Leisure, hospitality, restaurant workers, those type of things. Well, that's where a lot of these unauthorized immigrants are getting labor. And so, this was something. And so why are we hiring them? Because this is even what Jerome Powell said. He says, because, immigrants come in and they tend to work at a rate that is, hold on, let me get that low. Sorry. They work at a rate that is at or above that for non-immigrants, and not a rate of wage, but at the amount of work they do. Immigrants who come to the country tend to be in the workforce at a slightly higher level than Native Americans, but that's probably because of age difference. So they tend to skew younger. But and we've seen this because we've seen this hiring of immigrants coming into the country over Native workers, right? So we've seen the charts before of the number of native-born workers versus foreign-born, and so since 2019, we've hired 4.38 million employment workers that are foreign-born versus a loss of 513,000 native-born workers. And this goes right into corporate profitability because, again, if I can hire somebody cheaper than a native-born worker, then that boosts my profits. And so we continue to see this increase in corporate profits to wages ratio. In other words, so corporate profits continue to go up, and through productivity, increases in technology, advances in automation, and then of course hiring, I can continue to increase profitability, but it's at the expense of employee wages. And this is why we continue to see wage growth really remain stagnant. But this is to his point in particular. This chart is the employment net monthly change. So the blue is the net employment less the government hiring. So if you strip out government hiring, this is what you actually incurred. And so when we go back and look at some of these employment numbers where we were getting 300,000 jobs a month, 250,000 jobs a month, a big chunk of those, particularly in 2023, were predominantly government hiring. 2023 and really kind of mid 2024, this was massive government hiring. So ex-government hires, you didn't have a lot of hiring going on in the economy. And this is why these employment numbers never made sense to anybody. They're like, how are we getting these 300,000 jobs a month? And I'm looking around, and nothing in the economy suggests we're hiring that many people. Well, we weren't really. We were just hiring a lot of government workers.
Yep.
And so this is why when you start looking at what's happening in the economy and kind of where things are going, when you start cutting back on government hiring, that's also fueling into wage growth. A lot of these government hires, by the way, have very high salaries, 80, 100, $150,000 a year, depending on their job. So they're higher wage paying jobs. You're stripping that out. But remember also the net effect of that, which is for every government job you reduce, you're also reducing a lot of other related jobs, contractors and other businesses that depend on those government jobs for
Right.
their business. So it's not just a clean surgical excavation of jobs where I'm going to just fire some government people and it's got no impact on the economy. You've got to think about the ripple effect across all the other jobs, particularly in DC, that are all dependent on those government employees, right? Whether it's dry cleaning or restaurants or maid services or manufacturing, whatever it is, they're very dependent on those government jobs. So if those jobs go away, those other jobs go away as well. So there's real risk that we get much slower rates of economic growth on the employment side in the next several quarters. And then the same thing on the spending side. So this is GDP. The blue shaded area is the deficit reversed. So if you start reducing the deficit, what's important is there's a negative correlation between deficit increases and deficit reductions. And so if you reduce the deficit, you're going to get slower rates of economic growth.
So you're
again,
taking
and that's to his point about government spending. You strip out government spending, which is the deficit, you don't have much economic growth to speak of.
Right. And so again, yeah, the government has really been driving economic growth. Without that spending, we should expect less economic growth. Now that the debate should be, okay, how much less, right?
Mm-hmm.
But a couple of things that are important to mention. So we got the new jobs numbers today, as you mentioned. They were below expectations, but not terribly below, right? No one's really freaking out. Now, the unemployment rate creeped up a little bit to 4.1%. What's interesting is if you look at the underemployment rate, right? So U3 is unemployment rate, but U6 is underemployment rate. That actually is moving pretty fast now. It's up at 8%. So if you look at the trajectory and momentum of that is actually starting to become a worry. Now, obviously, we've got layoffs that are happening at the government level, right, which has really been the driver of the employment growth numbers, as you mentioned, right? So that's going on in real time right now. We have DOGE as well, just saying, look, we're trying to find ways to cut government spending. And right now, it's been a lot of onesies, twosies. But one potentially important development is, there's been legal pushbacks against what DOGE is trying to do, saying, hey, look, it's Congress that controls the power of the purse. And if Congress has approved this spending, you have to spend it. Like you can't get in the way of that. If not, you're overstepping your executive authority. And that obviously is, we'll learn what the courts think about that. But apparently, and I'd heard a little bit about this beforehand, about this term, rescission, which essentially is when spending is approved by Congress, and then the executive authority says, okay, I get that you approved it. I'm just not going to spend it, right? Mm-hmm. And the debate right now has been, well, Congress, look, if Congress has mandated it has to be spent, you have to spend it, right? Apparently, Rand Paul and Elon Musk and I guess some other folks met yesterday, but apparently they explained to Musk that, hey, rescission, the ability to say, look, we're deciding not to spend the funds approved by Congress. You can go back to Congress and say, hey, can we basically invoke rescission here? And that only requires a 51 vote majority in the Senate, not a 60 normally. So that 51 vote majority is within the Republican 50. I think the Republicans have 53 seats in the Senate, if I'm remembering correctly. Yep. So that may get approved, and that could be a pretty big deal. So TBD. But my point is just there's a lot of things going on that are going to be continuing to restrict government spending as best we can tell at the moment. And so therefore, this whole concern about slower economic growth, I think, becomes even greater concern.
No, absolutely. And again, just, this has kind of been the drumbeat ever since the beginning of the year, is that, the outlook for economic growth is not great. And by the way, if economic growth slows, so does inflation, because inflation is a function of activity in the economy. So if I'm buying or selling goods and services and I get slower economic growth, I get slower inflation.
Right. Let me just add
Right.
one thing to that so you can address it in your answer.
Sure.
Because this was the question I meant to ask leading up to this, which is, yeah, inflation goes down, but why does inflation go down? Right? Because consumers spend less. Why do consumers spend less? Because generally they're getting laid off. Right. So my question is, can employment's hung in there all this time? Can it continue to, or are we potentially uncomfortably close to the point where we really start to see the unemployment rate start to go a lot higher here, and then that whole vicious cycle that usually brings us into recession is unleashed?
Well, again, that's yeah. As we just kind of went through, I think the recession risk isn't zero. That's my whole point, right?
Yeah.
How high is that recession risk right now? I don't know, but there are certainly things going on. If you start you start deporting. Okay, so two things. Let's just go back through the 3 points without going through the whole article. So one, you cut government spending. Government spending is a huge input into the economy, and that's been supporting economic growth over the last 5 years. And we've talked about the lag effect of the reduction of spending. It's now showing up in the economy. Now, let's just assume for a moment that we don't deport any immigrants in the economy, right? Border crossings have fallen by 96 or 97% since Trump took office. So we're not getting any new immigrants into the economy right now. So that alone is going to slow some of the economic data that we see in terms of employment, spending, economic activity, et cetera. If you do deport, a fair number of illegals, then that's going to have another impact itself. By the way, deportation of illegal or non-authorized immigrants is not a new thing. During the Obama administration, he deported 5.4 million people during his 8 years in office, and the economy did not collapse. Inflation went down, and the markets did okay. So as opposed to a lot of these headlines that you see running around, it's like, oh my gosh, if Trump deports all these people, the whole world's going to crash. The expected rate of deportations is about on par with what Obama did. It might be a little bit more, might be a little bit less at the end of the day, but it's going to be about on par to what Obama did during it. And the economy was fine. And that's because economies adapt, right? If I can't hire an illegal to do the job, I'll hire somebody else. You just have to pay a little bit more for that. But it does impact economic growth somewhat, but it doesn't lead to this big dire, devastation of the economy that I read in some of the headlines. So just keeping it kind of real. But it is going to have a drag on economic growth if you start cutting immigration off to a large degree and starting deporting immigration or deportation. That's certainly going to impact economic activity because you're taking people out of the spending pattern. Again, 70% of the economy is what we buy and what we spend in the economy. It's our consumption.
What real people buying,
yeah.
So illegal or not.
If you take people out, you're going to have less economic growth. And so, and then ultimately at the end of the day, so you're cutting spending, you're deporting people, doing deportation. And then you've got the overall impact of just less activity happening within the overall economy. Now, look, you take a look at the Challenger job layoff data. That's up like 250% in like the last couple of weeks.
Yeah.
So we're seeing a lot of those are in DC, but we're seeing that impact now. So if you strip out those government hires, you're going to see slower rates of employment growth. You're going to see slower rates of economic activity. And that doesn't necessarily mean that the economy goes into recession, but it's very tough to see how you're going to keep generating 3 and 4% rates of economic growth that we've seen over the last couple of years, how you're going to do that over the next couple of years. And where that's really important is when we start talking about corporate earnings, because where do corporate earnings come from? It comes from the consumption in the economy. So if the economy is slowing down, corporate earnings are going to be very hard to justify at $287 a share for 2026 right now. Right. It's very hard to do it sub 2% growth.
Right. And then what do you do as a corporation when your margins start getting squeezed? You start cutting costs and start laying off.
Absolutely.
Yeah. I had the great pleasure of getting to meet Melody Wright, the housing analyst, in real life last week. She was on her California boots on the ground tour, and she came up to Northern California. So we went and got to chat, and it was very nice. But as she will share at the upcoming online conference for Thoughtful Money, the last time she was on the channel, she said she had been really hesitating to stick her neck out and predict a national price decline for the U.S. for this year. But when she got the December data a few weeks back, she said, I'm confident enough. I'm now calling for price declines. After this latest tour of California, she's like, oh, I am so much more confident in that call now.
But it is California.
Well, California is a big bellwether for the country, right?
Yeah.
So Texas, Florida, a lot of those markets had a lot of idiosyncratic things that were driving prices way up, and they've caused the corrections we've seen there. California is such a big part of the country, but also those trends are trends you would expect to see in a lot of other places as well. So anyway, she's basically saying, look, I think the housing correction's on. It's going to be multi-year. That's going to have its own wealth effect, negative wealth effect issues in it. But the analogy I want to draw here is we talk about how there's this inventory shortage in the country, and yes, in terms of what's on the market for sale, but not necessarily in terms of actual structures. And there's a lot of institutional and investor ownership of a lot of properties out there, whether it's the Blackstones, whether it's the short-term rental people, but a lot of boomers. A lot of boomers just have second, third, fourth houses, right? And so that's the inventory that's going to start getting dumped on the market sooner rather than later, right? Oh, times are beginning to get tight. Let me sell the house that I don't live in, right? We've had job hoarding going on in a lot of corporate America because they remember the pain of having fired everybody too fast during COVID, and they've really been holding on to that workforce as much as they can. I think similarly to what might happen in housing, which is when things start to get pinched corporate profit wise, you're going to see just a lot of shedding of all the people that they weren't their top employees, but they just didn't want to give them up yet, right? And you're going to see like a short-term flushing of that too, I fear.
Yeah, that's called labor hoarding, and that happened. Corporations.
Right. Well, it'll be labor dishoarding, is what I'm talking about.
No, the term is labor hoarding, and what that means is corporations are the worst about managing employment. Is that they hired, they hire too many. They're late to hire, right? They really wait for the economy to show an upturn after a recession to start hiring people, and then they're really late to start firing people. So you'll be well into a recession before you really see the unemployment rate go up a lot, because they to your point, they hoard that labor as long as possible until they simply just can't hold on to it anymore. And it does come down to corporate profitability, et cetera. So, but the same thing you're going to see this in a lot of areas, as we go forward. And again, what's going to be interesting coming back out of that next cycle is we lay off all these employees, and then we figure out how to do that same amount of labor or same amount of work with the existing labor by overlaying more artificial intelligence, more computerization, productivity increases wherever we can. And so a lot of people that may get laid off may not ever get hired back.
May not get back. Yeah, and that's it's a threat we've talked about a fair amount, but that's a big discussion that we should really dig into at some point in time, but not now, because now I got to start flipping into lightning round mode with you, because I want to get to your trades, and then I want to get the rant in if we can. Sure. All right, so lightning round. We had the president's address to Congress earlier this week, and he made two really bold economic promises to the public. And my question to you just, Lance, is, are these even possible, or is this just empty political posturing? So he said he wants to balance the budget, and he said that he wants to pay down the debt. Now, he didn't necessarily say pay down all the debt, but he did say, expect we're going to pay down debt. He also didn't give a when, right? So he didn't say this year. But do you think either of those is really remotely probable?
The answer is it's absolutely. Let me couch this answer. So I watched that whole political joint address to Congress, and it was, the takeaways from it were both good and bad. It was the sad side about it was the Democrats who, could not find it within their realm of humanity to at least applaud for a kid with cancer. right? I mean, there's just, they're so dug in, and there's a reason I'm saying this. They're so dug in against President Trump and the Republicans that they're not going to do anything. So if we had a functioning government and both Democrats and Republicans could find common ground to work on, balancing the budget is absolutely possible. It could be done within a couple of years. Because again, we already know just from some of the early, kind of endeavors by Doge that we have a lot of just spending that the vast majority of Americans simply don't agree. Look at the polls. They don't agree with sending money to other countries for stuff that really has nothing to do with anything.
So agreed. Just let me make this point so you can address it in your answer. Yes, but for whatever that money is getting spent on, right? And I know it's a good chunk of it's going out of the country, but whatever that money is being spent on, it is getting spent, meaning it is driving economic growth. So the question is, are we willing to still stay on our,
Well, let me finish.
Yeah.
So yeah, it's driving economic growth in other countries because we're not spending it in this country. It's going elsewhere. Right?
Well, part of it, and I don't know what the breakdown is, but yeah.
Well, there's a good bit of it, several billion. So my point is that if you could start if both sides come together and look at the budget, there's this great movie if you ever get to watch it with Kevin Kline called Dave.
Yeah.
It's an awesome movie, right? Where he's got to find $694 million for a program, and he starts redlining the budget, right? Just, there's money we can save right there, right? And that's all it would take is to really dig into what we're spending. There's so much money that gets spent on things that are special projects, dog-eared projects, benefit some particular little region of the country or not. And yes, it's going to impact that. If we cut spending and balance the budget, you're going to have an economic slowdown. No doubt about it. Probably have a recession.
Well, that's what I was going to say. I mean, it's probably a recession or a deeper recession than we already are likely to have. Yeah.
But again, is it? But the question was, is it possible to balance the budget? Absolutely, but not having a dysfunctional government.
Yeah.
I mean, we just found $2 billion of foreign aid that they wanted to get, and we can't even get rid of that, right? So there's $2 billion we're going to spend that's going to other countries for non-essential purposes that we could have saved. But now because of this judge, it's going to wind up getting spent anyway. So we're not going to make any headway in the right direction. And that's the fascinating thing about all this, right? Everybody, you read all these articles, you read all these headlines like, we're going to lose the dollar reserve status because of the deficit. And, we're spending too much money. Look at the debt. It's $35 trillion. But yet but these very same people, when it comes down to saying, okay, here's what we've got to do to get there. And we talked about this last week. This is the price you're going to pay to fix the debts, fix the deficits, get the economy back on a good track. All of a sudden, nobody's willing to do that.
Yeah, it's the whole kind of NIMBY, it's the economic version of NIMBY. And just to be super clear, my question was not possible, it was probable. And I just want to clarify, I'm 100% for fiscal responsibility. I've been taking a lot of slings and arrows on Twitter or X recently for saying that the American public should be brought into the conversation of, are we willing to try to keep the system limping along with all its inefficiencies to avoid a recession, maybe even a deep one, or should we take the pain of the deep recession and then have a much saner baseline coming out of it, right? So I'm all for generally taking this pain, or at the very least, I think the public should be involved in the debate and be allowed to have a voice in it. But I'm just wondering politically, is it really probable? Is that a promise that's going to haunt him because in his fourth year, we're nowhere close to balancing the budget, nor have we paid off of debt?
Probably. Again, he's going to have, this is going to be a tooth and nail fight for 4 years. If anything happens in 2 years and they lose control of the House or Senate, he's dead in the water. So if I'm him, if I'm going to do rescission, I would be doing that right now. I mean, everything that I need a majority vote on to get passed, I'd be pushing that through Congress as fast as I could right now, because you're probably going to lose the Congress or the House in 2 more years. And then you're going to be dead in the water.
Which probably explains why the administration's moving so fast.
Yeah.
All right, another lightning round thing, and let's try to avoid getting spun off on this because I'm sure we could. But yesterday, President Trump announced a Bitcoin strategic reserve. Does it really mean anything in the sense that all we did basically was, so it's being funded with Bitcoin that was already more or less
Seized.
confiscated by the
Yeah.
government or given up in forfeiture from criminal activity. So essentially, we just took the coins from one digital wallet to another. Maybe we just took the digital wallet from one drawer and are putting it in another. Right? I mean, does it really mean anything?
No, I mean, well, it does because now we can say we have a reserve, right? But what everybody was hoping for
But
is
didn't we
that
have one the day before? We just weren't calling it. It was still
we
in a
just didn't
drawer and
call
it
it
was
that,
still
right?
ours.
Right?
Yeah.
Yeah. Well, no, that's right. But now we have a reserve of cryptocurrency. What everybody was hoping for in the crypto market is that the government would commit to buying
Right.
crypto, and they would say we're going to spend $100 million a year, $1 billion a year, whatever, and we're going to be buying on a consistent basis, Bitcoin, Ethereum, Solana, whatever. But really, what it turned out to be, and that's why Bitcoin really sold off a lot. That and the fact that it's correlated to the stock market because it's a risk asset. Um, but now it's just a function of whatever we capture in a raid or through seizure or forfeiture, et cetera, we'll stick into that reserve. So
Right.
that really doesn't
It
help.
does say there's provisions in there to
Yeah,
continue to acquire it at budget neutral, uh, on budget neutral terms for the American public, but
which
it's not
means
clear
through
to me what
seizure.
that really means. Yeah.
Yeah, when you say budget neutral, that's through seizure
Yeah,
or
exactly. It
forfeiture.
means we're not spending money on it. Yeah, exactly.
Correct.
So, okay. Okay. All right. All right. I'm going to skip over some of these other things. Trades. What trades have you guys made this week, if any?
We bought energy late last year. We sold our energy positions kind of early last week, just because this was really kind of a part of a function of his speech as well. He talked about drill baby drill, which is going to increase supply. That's not great for energy producers.
So,
Too much
sorry to
supply.
interrupt,
Go
but
ahead.
there was a headline today. I was going to ask you about this. It's
Sure.
one of the ones I just punted. But the head of the Department of Energy just announced plans for a 20 billion refill of the depleted
Yep.
Strategic Petroleum Reserve.
Yep.
Will that have any impact on
Yeah,
oil
yeah,
stocks or
that'll
oil
bring.
prices in the short term?
Yeah, that again, you're adding demand to the oil supply, so you'll see prices come up short term. But again, if you're going to drill a lot of oil, that's going to put pressure on oil prices. And
Yep.
again, that's kind of what he wants because that feeds into inflation. So if I want to get inflation down, I need to bring
Right.
the
You got to get
price
the
of
price of
oil
oil
down.
down. Yeah.
Right. So we had two oil positions that we sold in our portfolio, and then we trimmed back on AbbVie, Costco, Walmart, which has had huge runs. So we took profits there, and then we've just been nibbling a little bit. We bought a little smidge of Nvidia this past week, a little bit of Microsoft, a little bit of Google, a little bit of Palantir, just on this big price decline. They're still under in a correction, but we're kind of just starting to nibble a little bit at trying to pick up some discounted prices.
Okay. All right. But you are practicing what you preach, right?
Mm-hmm.
You're trimming your winners. You are nibbling in on ones that you core holdings of yours that are
Mm-hmm.
getting below your general targets. And then you've sold off some energy.
Yeah.
Okay. Now to the rant. All right. So sort of the topic of this rant is uh, we should periodically look at our lives and what we're doing and basically look at where we have a disconnect between our actions and the results we want to see. Right? Like, where am I spending a lot of focus and energy and I'm not getting the results that I want? And if there's a protracted enough time of you doing that, kind of spinning your wheels or underperforming, then seek expert counsel and really listen to it. And here's a great example where that did happen and then didn't happen. And I think it's emblematic of probably a lot of people, and I've certainly been guilty of this at times in my life. But this is probably one of the more fun examples. And folks that have been following me for years have probably heard me talk about this before. Lance, I heard about this first from Malcolm Gladwell, the guy who wrote The Tipping Point. And it's the story about how Wilt Chamberlain scored his 100-point game. Right. You remember hearing about that, right? It's still an unbroken record in the NBA today, right? In the 1960-1961 season, there was a game where Wilt Chamberlain single-handedly scored 100 points, right? And what people don't really appreciate about that game was the number of free throws that Wilt made. He had 28 points worth of free throws, which was notable, especially for him, because he made 28 out of 32 free throws that he took. That was an 88 successful completion record,
Right.
which for Wilt Chamberlain was phenomenal because his career average was 50% from the free
Right.
throw line.
He was a terrible free throw
He
shooter.
was a terrible free thrower. In fact, he was notorious for it, that they would take him out near the end of the game because if a
Mhm.
game was close, you'd go foul Wilt, he'd miss the shot, you'd get the ball back, you'd get another chance to score, right?
Right.
So, anyways, um, do you know why his free throws were so good in that game?
That's the game he did the granny throws, right?
Exactly.
That's right.
So he was so bad at free throws that the his coaches said, "Look, we got to work on this, Wilt." And so they got the best free thrower in the league to teach him. And the best free thrower in the league was Rick Barry, who played for the Golden State Warriors at the
Right.
time. His career percentage over a 15-year career was 90% from the free throw line. In fact, one year his all-time high was he shot 95%, which was ridiculous. Like nobody comes close to that. And he did it all doing the granny shot. And really, what Rick Barry, uncovered was that, if you just look at it from as a physics problem, there's a lot less moving parts to go wrong when you do the granny shot. So, he was sinking him from the line. He taught Wilt to do that. And then, Wilt went, and that year he was taught by Rick Barry, his free throw percentage rose to a career high of 61% that year. And again, in that famous 100-point game, he had 88% from the line, right? So, like, changed his behavior for the better by listening to an expert and totally saw amazing results, right? Now, what's interesting is Chamberlain stopped doing it. Here's what he said. He said, I felt silly, like a sissy shooting underhand. I know I was wrong. I know some of the best foul shooters in history shot that way. Even now, the best one, Rick Barry, shoots underhanded. I just couldn't do it. So he stops doing it. His free throw percentage sunk to a career low of just 38% by 1967, right?
Right.
So this guy had all the evidence in the world of how to do the right thing, but he just couldn't bring himself to continue doing it. It's crazy because they estimate that just free throws alone, he would have scored over an additional 1,000 points in his career if he had done granny shots rather than regular overhand.
Right.
And then he probably would have actually scored even more total points in his career because he would have been in the game more, right? He wouldn't have been, they wouldn't have been intentionally been fouling him in the
Right.
final minutes of every game, right? And he would have made a lot more money, right? I mean, his team would have, he would have scored
Sure.
more points for his team. He would have played more. He would have gotten a bigger contract, right? So the point here is uh, when something's not working, look to what the people who are successful at it are doing and learn from them and listen to them and stick to it. And don't let kind of our behavioral biases sabotage you, right? So that's a famous example with Wilt Chamberlain. I've had plenty of examples like this in my life where I've either just, been stuck grinding my gears and didn't pick my head up and look to somebody who was doing it better than me, or I didn't listen to them or I didn't follow their example. I think the biggest most seminal one for me in my life, and we've talked about this, was when I gave notice at Yahoo, and I just said, look, I can't continue to work the corporate rat race anymore the way I've been doing. I need to do something that's more meaningful in my life. And I was about to turn 40, and I'd had several different moments in my life where I'd said, look, I'm not enjoying what I'm doing. I got to figure out something better to do that's more aligned with, myself and what I want to do. And yet I was continuing to find myself on a path where I still felt unfulfilled, stuck, or just not nourished with what I was doing on a daily basis, right? So when
Right.
I gave notice at Yahoo, I fortunately worked out like a 6-month severance plan before it was going to be my last day there. So I had a paycheck for a while. But I said very early on in that 6 months, I said, look, I got to admit, I am not solving this problem for myself on my own. I got to pull in the pros. And so as I've mentioned many times before, I worked with a bunch of different career coaches until I found one that was really good for me. I took every test known to man. I found that Johnson O'Connor test that many of you have heard me talk about here. And I really, let the process of those who were experts, in helping people find their true professions, their authentic paths in life. I really leaned into that, leveraged it, listened, and it made all the difference in the world for me.
Yeah.
So that's my journey. I got to imagine, you've probably got a lot of life experiences like this too. So I wanted to give you a chance to respond.
No, no. Yeah. No, I can name, many times throughout my career where I've made, terrible decisions and things have not worked out well. And, you had to, kind of reboot from ground zero in a lot of cases. And that's when we go back talking about mentors and again, looking at people that have done things that you want to do, have done a lot better than you. So, now this just goes back to that whole story about, if you want to improve and be better, really two ways to do that. First of all, put yourself in situations where you have to compete with somebody better than you, right? If you're already at the top of your game or you think you're at the top of your game, right? It's like, oh, I'm killing it, I'm doing great. Go find somebody who's better than you. And all of a sudden you'll figure out that you're not that great and you've got to improve more. And so I'm constantly, even today, trying to find things or trying to find other people that are doing things that I want to do better, that they're doing better than me. I'm trying to learn from them. So it's always, there's always room for improvement. And you may not like it, you may not like what they're doing, you may not agree with what they're doing, but if they're achieving something that you're not, try to figure out why. And if you can go talk to them, that's even better. If you can get, introduced to them or work with them or whatever, that is even a better way to get there, because again, we can always improve, we can always do better. And again, just it's kind of the Wilt Chamberlain story is funny because there's a lot of things that I kind of that mentally I want to refuse to do because I don't like them, right? It's not my wheelhouse, or it makes me uncomfortable, or I'm afraid of embarrassing myself or something like that. But when you go do it anyway, and you kind of face that fear, it helps you improve, and it makes you better at what you're doing. So again, it doesn't mean you're not ever going to make mistakes. It doesn't mean that you're not at some point that you're not going to do something that backfires on you. That's just part of the process. And then that's where we have to learn from the mistake, not quit, not give up, learn from the mistake, figure out, okay, I did that, it didn't work right. So now I got to fix it, I got to alter it, I got to do something different to get around that hurdle or whatever it is. But that's how you improve, and that's how you get better at what you're doing all the time.
Yeah, and so a key part of this is evaluating the beliefs that you hold. Um, and Chamberlain's beliefs sabotage them. Like there's a famous quote from Gandhi. I don't have the whole thing in front of me right now, but it's your beliefs shape your values shape your actions, and and that shapes your destiny, right? But it all starts with your beliefs, and it takes us a while to come to our beliefs, right? And so we have a lot invested in them, right? Because they basically influence how we act, and they're part of our identity. So we don't change beliefs easily. And we've talked a lot about in behavioral economics and whatnot, the risk of the backfire effect, right? Where I can have a belief, you can come at me with data that challenges my belief, right? And you're basically asking me to do the work of shifting my belief. And a lot of people's initial response is to actually resist. Like, no matter how many charts you show me, Lance, I'm just going to dig even deeper into my belief, right?
Yep.
And that's what Wilt Chamberlain did, right? I just felt like a sissy, right? And he totally tanked, his full potential because of that. And what's crazy to me about that story, and I should have mentioned this earlier, but it's like the key takeaway is nobody in the NBA shoots granny shots still. Like, we have all the data.
It's not cool.
Since then, barely anybody has. At the time that Gladwell's, when I first heard about it from Gladwell, I think the only person who was actively shooting underhand in the NBA at that time was Rick Barry's son, right? The kid who grew up and actually knew it, right? So it's so crazy that even though it makes all the sense in the world, the entire league still ignores this kind of gold nugget that's just sitting there on the ground. So a big part of this is looking at your beliefs and saying, all right, I got to be honest, is this belief serving me? Or is this belief really actually working against me? And if it is, then go through the hard work of shifting that belief. And one of the best ways to do that is to say, okay, well, if what's my desired outcome, who's really good at that, and then let me basically follow their lead, right?
Yeah. And look, I think what you're talking about is so key to investing,
Investing, and that's where I was trying to bring it all back to. Yeah.
Right. Is because, we get so ingrained in these particular beliefs. And that's why if you read our blog and if you read our newsletters and our daily commentary, that's us doing our research on how we're investing and what we're doing and how we're managing portfolios. And one of the, it's always interesting, one of the jokes you have about me is that you'll bring up a topic. I say, oh yeah, I wrote an article about that last week.
Hmm.
Because, and the reason for that is because you're pulling headlines out of the mainstream or out of the media, right? And these are headlines that are getting attention. It's what's driving the narrative, whatever it is. And so the reason I've written articles about that is because I've pulled that headline. I've seen the same headlines as
Right.
you. And I go, okay, well, let's see if I can prove or disprove that. And that's the work. And so just, talking about right now, there's still a lot of economists saying there's no recession. So I said, okay, let's prove there's no recession. And then we start going through thinking about immigration and deficit spending and these type of things. All of a sudden, that risk of recession is a lot higher than probably what most people actually think or attribute to the market. So, you know, again, you may not agree with what I say in these interviews with Adam. Just say, I don't agree with you, whatever. That's okay, right? That's what makes a market, is that we've got to have buyers and sellers. And I need you to sell stuff to, and I need you to buy stuff from me, and vice versa, right? So, that's what makes a market. So if you disagree with me, that's okay, but do make sure you're doing the work to say, okay, I'm entrenched into this belief about whatever it is. Try to disprove it. And if you can't disprove it, then you're probably right. But if you can start picking off your own argument by coming up with data that doesn't confirm that belief, you need to start rethinking about how you're investing. And this is what gets a lot of investors in trouble, is they start reading headlines, they get entrenched into, oh well, this is the next bear market, so I sell everything, and then the market rallies 5-10%, and then like, oh crap, I missed it, now I got to get in. And then that was just a reflex rally that led to the next decline. And we saw that a bunch during 2022. You had these big reflexive rallies that would suck people back in, and then the market would rug pull from underneath them. And then they were just constantly selling low and buying high, selling low and buying high. And the average return of investors in 2022, the market was only down like 21% at the end of the year on a total return basis. The average investor was down between 35 and 40% during that year, because too much leverage, buying stuff at the wrong time, selling stuff at the wrong time, just constantly doing the wrong thing. And so whatever narrative you have, challenge it. That's the part of the exercise. The way we challenge is we write about it, because if you can write it down and prove it or disprove it, that's a much deeper process of really understanding what your argument is.
Yeah, that's a great point. And I would say, like basketball, which is all about stats, right? So is investing. So, if you're, you always warn people about being, too into whatever their bias is, right? So we'll take bears because there's a huge bear behind you right now, right? Somebody that's been super bearish about the American economy for years because of all the risks that we talk about, but the ones that get inflamed, oh my God, the US is going to lose its, US reserve currency status, and we've got all this debt, and we're going to collapse under it at some point in time. And, all this stuff that, who knows, may prove true over a long enough timeline. If you have put all your chips on an extreme end, well, just look at your investment performance. Right? Is it how is that belief serving you? And if you're like, you know what, I kind of got out of the market, years ago, and I've just been in all these sort of Armageddon trades that haven't done very well, then yeah, maybe you want to reevaluate that belief. And again, that's not to say don't be cautious about the market, but don't be so extreme in it, right? Same thing just with DIY investors. I mean, well, let me just say this. There's a lot of, I know there's a lot of people that watch this video. In fact, the majority of people who watch this video, I believe, are DIY investors. And I know that from having surveyed folks. Now, what I would say is that, I think the data shows that the majority of DIY investors don't beat the market, don't match the market, nor do they match the average financial advisor return, right? And what I would say is, well, look at your track record, right? If your track record's good, great. You got nothing to worry about. Keep doing what you're doing, right? Maybe, do Lance's exercise of still writing down what you think, but you seem to be doing a good job by your track record. But if you look back at your track record and say, I've consistently underperformed, then maybe challenge that belief and say, well, maybe being a DIY investor is not the best thing for you. Maybe your best thing is finding a better pro to manage your money for you, and you can focus on the things that you can outperform on, whether that's increasing your income or whether it's increasing your savings or whether it's just spending more time with the things you care about in life and letting somebody else worry about the money stuff.
Well,
So again,
that's
it's
always
looking at those beliefs. Yeah.
yeah, and that's always the most fascinating thing to me, right, about investing is that, and look, there's nothing wrong with do-it-yourself investing, right? We built a whole platform for do-it-yourself
There
investors.
is nothing wrong with it. I would just say, unless you are working against your interests, and then you should be
Well,
honest
that's my
about
point.
it.
Is that's my whole point. Is it's interesting because we go to school to become a doctor, a lawyer, an engineer, whatever it is, so we can have a profession that we're really knowledgeable about, really good at. And yet a lot of these very same people have spent years getting an education to be the top in their field of whatever profession they choose. They also try to invest in the most complicated game in the world, which is you've got to understand, politics, geopolitics, economics, finance. You've got to understand all these different
Right.
facets.
And we don't teach them that stuff in school. Certainly
Bingo,
not in
right?
med school or law school. Yeah.
Yeah, and so it's a far more complicated game. And then on top of that, you're competing. You as the individual investor with your set of tools, you're competing against guys like Ray Dalio at Bridgewater who have 100 PhDs on staff,
Right.
spend $100 billion on computer equipment, algorithms, and all this other kind of stuff to trade the market ahead of you. And they're simply there to take advantage of all your mistakes. And that's the thing that we try to navigate in our shop, is trying to understand all of those different dynamics in markets. That's why we spend so much time on technical and statistical analysis. Mike does a lot of work on, and we've published this all in, Simplivisor, looking at relative rotations, absolute rotations in the markets, looking at where assets are traveling, who's most oversold versus most overbought, because those are where your opportunities present themselves, because that's where people are getting off on the wrong side of a trade.
All right. Well, look, I think we've made the point here, folks. But yeah, don't be a wilt. We'll put it that way. Lots of other
Learn to
other
shoot
parts
underhanded.
yeah, lots of other parts of Will Chamberlain to aspire to be. Don't get me wrong. Though not all of them. He definitely had some controversial parts of his background too.
Yeah.
But don't be a wilt. Don't put your head in the sand where there's clearly better stuff that you could be doing. And as I said earlier, start just by looking at your beliefs and then looking at the data and say, look, are my beliefs working for me or working against me? And where they're not working for you, that's where you want to spend some time saying, maybe I should shift that belief and start doing things differently.
Yeah.
Exactly. All right. Well, look, if you think that one of the best ways that you could increase your performance is by leaning into your belief that really one of the best uses of your time is to continue watching Lance Roberts on this channel week in and week out, let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Obviously, if you want some help from a financial professional in guiding yourself through this year ahead, which, Lance, definitely is shaping up the way that you thought it would, which is certainly a less fun ride than the past 2 years. Highly recommend that you do that under the guidance of a good financial professional, one that understands all the macro issues that Lance and I have talked about here. If you've got a good one who's doing that for you, great, stick with him. Like I said, don't mess with a belief that's working for you. But if you don't have one, or you'd like to get a second opinion from one who meets those criteria, perhaps even Lance himself and the team there at RIA, then fill out the short form at thoughtfulmoney.com, and the firms will be in touch with you right away to have a consultation with you. All right. And don't forget to, while you're there at thoughtfulmoney.com, don't forget to go to thoughtfulmoney.com/conference and run, not walk, to go buy your ticket if you haven't already for our upcoming spring conference on Saturday, March 15th. Lance, that's just going to be a week away when this video releases. Really looking forward to that day. I won't go in depth on the amazing faculty of experts we have, except to say it's A, the best we've ever had so far. B, it's the most we've ever had so far. So the day is incredibly packed with content. And then C, we just told this whole parable about listen to the experts, right? So what better time to come and actually listen to some of the best experts on money in the markets right now. So folks, if you can't watch live that Saturday, don't worry. Replay videos of the entire event will be sent to everybody who buys a ticket. And a reminder, if you are a premium subscriber to our Substack, if you buy your ticket, you'll get $50 off the ticket price with the promo code that you've been emailed. All right, Lance, another great week. As usual, I'll let you have the last word here.
For all you people that are the haters in the comments that are always like Michael Leibowitz better than me, well, guess what? Next week, you get to have Michael Leibowitz because I'm on vacation with my kids.
All right. We'll have a fantastic vacation. Look forward to having Mike on.
Yeah,
We'll see you in 2 weeks then, I guess.
you got it. See you then.
All right. Everybody else, thanks so much for watching.